Today's tax tip is to contribute to your retirement accounts. It's one of the best things you can do after year end. If you haven't already funded your retirement accounts for 2020, you can do so by April 15th of 2021. That's the deadline for contributions to a traditional IRA, whether that's deductible or not, and to a Roth IRA. The good news about thinking about this right now is the 2021 year is also available for contributions if you funded your 2020. If you have a KEO plan or SEP and you get a filing extension to October 15th of 2021, you can wait until then to put those 2020 contributions into those accounts. To start tax-free compounding as quickly as possible, don't wait to make those contributions. Making a deductible contribution will help you lower your tax bill this year. Plus, your contributions will compound tax deferred. That's one of the best and simplest tax saving strategies that I can provide for you. For example, if you put away $5,000 a year for 20 years in an investment with an average annual 8% return, that $100,000 of contributions, that grows to $247,000. The same investment in a taxable account would grow to only about $194,000 if you're in the 25% federal tax bracket. And for instance, us here in Illinois, we also have state taxes on top of that. To qualify for that full annual IRA deduction in 2020, here are a couple of the points to be aware of. You must not be eligible to participate in a company retirement plan, or if you are eligible, you must have adjusted gross income of $65,000 or less for singles, or $104,000 or less for married couples filing jointly. If you are not eligible for a company plan, but your spouse is, your traditional IRA contribution is fully deductible as long as your combined gross income does not exceed $196,000. For 2020, the maximum IRA contribution you can make is $6,000. It's $7,000 if you're age 50 or older by the end of the year. For those self-employed people, the maximum annual addition to SEPs and KEOs for 2020 is $57,000. There's a few more rules and stipulations with those. We'd be happy to sit down and walk through if that's the best choice for you. Although choosing to contribute to a Roth IRA instead of traditional IRAs will cut your 2020 tax bill, since Roth IRA contributions are not deductible, it could be the better choice because all withdrawals from a Roth can be tax-free in retirement. Withdrawals from a traditional IRA are fully taxable in retirement. To contribute the full $6,000, and again, $7,000 if you are age 50 or older by the end of 2020, to a Roth IRA, you must earn $124,000 or less a year if you are single, or $196,000 if you are married and file a joint return. The amount you save from making a contribution will vary. If you are in the 25% tax bracket and make the deductible IRA contribution of $6,000, you will save $1,500 in taxes the first year. Over time, future contributions will save you thousands, depending on your contribution, income in the tax bracket, and the number of years you keep that money invested. So hopefully that was a good and useful tax tip. Again, if you find that value out of our YouTube channel and Facebook post, feel free to click subscribe. We'll have lots more of these coming up. And click the like and share if you're on Facebook. Like our page. Everything helps us get these tax saving tips out to somebody who could find them valuable and hopefully save some taxes and pay Uncle Sam as little as they are required to. All right, thanks. Have a good day, and we will talk to you soon.